Well, for those of you unfortunate enough to not have won round one, let's take a look at what assignment you need to do. So, first question is, suppose Ferris wanted to reduce its leverage ratio at the end of round one by using cash to pay down debt. What amount would have been necessary for Ferris to have achieved a leverage ratio? Right? And leverage is assets divided by equity as defined in our game. Now, that's one that took me a little while to get used to, and I'm still not really, because we always use debt to equity ratios or in banking, and so this one's just kind of calculated a little bit differently, and it takes me a little bit to wrap my arms around it. But let's take a look then at what we might be talking about here. So, okay. So we look here, leverage, and we come to Ferris. Ferris's leverage ratio is only 2.1, so it's not huge, okay? And because I'm just asking you to take it down to 2. Well, what do I mean by that? Well, let's come down to our financial statements and our balance sheet, okay? So if we took its total assets, $134,233,000, and divided that by our equity, $64,544,000. You can see, that'd be 100 and what, 28. Yeah, so that's why it's just a little bit over 2.1. Okay. So we need to calculate then, and I put it specifically this way. I said if they paid down debt, and the reason for that is simple, that paying down debt is not going to change the equity. It just won't, right? You're using an asset, but you're paying down debt, so you're reducing both your assets and your liabilities by an equal amount. So the equity amount stays the same, but obviously the asset amount goes down, and so your leverage ratio would come down as a result. So I put the formula in here. I said leverage is equal to assets divided by equity. And why would you do that? Well, because you're going to know then 2 of the 3 legs of that equation. So your leverage, I'm asking you to solve for a 2. So your equation is simply going to be 2 equals, assets is going to be the one that changes. Our equity is going to stay the same. So whatever our equity is, according to our courier, 64,544,000, right? So then you just have to solve the algebra equation. Algebra. God, we got to do algebra. Yeah, sorry. You got to do a little bit of algebra. There's actually a little easier way to do it too, but I'm going to make you guys do the algebra. Unless you can figure out the easier way, you can do that then. If I remember, I'll show you the easier way when we do the when I do the review of the assignment. So, 2, how much additional income did Erie earn in the low end? Product deb only, so let's just look at that one. In other words, net after taxes, how much more did Erie make because Ebb sold above its potential? Sorry, I got to pause here for a second. I'll try to pause here for a second. So I believe I was on question 2 there, and it's how much additional income did Erie earn in the low end? Product deb only. In other words, net after taxes. So we got to calculate taxes now. In other words, net after taxes. How much more did Erie make because Ebb sold above its potential? Okay, and even if Erie lost money, it's still actually net after taxes. It improved its performance. We got to take a look and see. Okay, so first let's come down. It's the low end, right? So you don't really need to concern yourself with whether Erie made or didn't make money. If you determine how much more it made as a result, okay, then that's going to get you the answer that I'm looking for. So again, this is a step-by-step process. It looks like Erie benefited to the extent of about 4%. But look down below, right, to get the actual numbers for the potential versus actual, because this is for the entire thing, and it may be different just for product deb, right? If I come down to the potential versus actual, ebb, 13.8 actual, 9.3, okay, So then you take that and you multiply it by whatever the total demand was, 4 or 5%, right? So they could have sold, 400,000 more products at whatever the price was that they sold it at, okay? Then we got to figure out what our marginal cost was on that. Okay? They might have had some left over, but the last few that they sold and whatnot should have been at the marginal cost, and so we go up right to the production analysis and we calculate what our marginal cost was for ebb based on those two numbers, right? 705 and 803. So now we got our cost. We know what our income was because we were able to take that times the $23 sales price that we had. Then you need to look up that should give you then, right? Sales per item 23, cost per item 15, so roughly we made $5 per item, and we sold an extra 400,000 items, or we did sell an extra like 400,000 items, somewhere in that neighborhood. You guys got to do the calculations, so that's a couple $1 million. Now you got to dig out your guide and see what your tax rate is. It's in there, okay? The guide's not that long. You should have read it about 3 times by now, and it tells you what your tax rate is because now their income's going to be reduced by whatever that taxable amount was. And again, that doesn't matter whether Erie showed a profit or loss for the round. Don't concern yourself with that. Concern yourself with how much more they made on that particular product. If you look at your own, you could look at your statement, and it tells you how much you make per product. When you look at your income statement, it breaks it down by product, and that's kind of what we're doing here, okay, for Team Erie. Okay, 3, Chester's forecasting sales next round in the high-end segment. It is estimating it will sell 490 units of SID, its high-end product. Chester wants to have an extra 10% of units on hand above and beyond its forecast in case sales are better than expected. So 490 times 1 plus 10%, right? It would risk the possibility of excess inventory carrying charges rather than risk lost profits on a stock out. So taking current inventory into account, so we also have to calculate that. What will Chester's production have to be in order to have a 10% reserve of units available for sale? I got bonus for including an adjustment. Yeah. So my steps are there, right? So first, what am I estimating I'm going to sell? Well, it's estimating that it's going to sell 490, but I want an additional 10% of units. So my first step is taking 490, calculating what my projections would be then by adding the 10%, which is 49 units, right? Okay. So you do that, okay? And then you got to subtract from that its current inventory, okay, which is pretty easy to look up, okay? And that's going to give you then the amount that you would need to produce. Okay. However, and this is just a bonus, when you look at your production schedule, if you guys look at your own, you'll note that your desired production, your requested production is actually reduced by an amount. Okay. And so if you include that, I'm going to give you a little bonus. 4, what was the cost, the total expense, fee plus interest of Digby's emergency loan? Or Erie, take your pick. Okay. So we've looked at that in the past. I asked you to calculate what Uncle Al charges a little fee, but then you got to look at what the interest rate is too that you're paying for that particular emergency loan. You might have to look that up. Again, that's probably going to be in the guide. It's going to tell you roughly what that. I'm not sure if it tells you exactly. I think it might, but it gives you an idea because you're going to have to calculate what the fee is. That's an upfront fee of X%, and then also their interest rate for the year of X%. So get those done. That should be it for the assignment there for round 1C.